Hi, I'm Max Keiser. This is the Keiser Report. We are in Kingston, New York, the entrepreneurial capital of the Hudson Valley, right? Yeah, we're here as guests of Gerald Celente's Entrepreneurial Conference, an annual confab that attracts the best and the brightest entrepreneurs around the world. And of course, we must dig deep. Stacy, tell me.
Well, we're going to look at the general economy that has been happening while we've been on vacation. You know, everybody's been watching these summer solutions for the past few weeks, but stuff continues to happen in the markets. Even though Keiser Report wasn't there live reporting on it, stuff was happening, and we're here to say that we had our eyes on it. Nevertheless, we saw what was going on, and I'm going to read this tweet first because one of the themes here at the Entrepreneur Conference in Kingston with Gerald Celente has been about central bank intervention and what the intervention has done. And many people say, oh, it's great, they saved the banks and we have an economy. But we're going to look at some of the crazy headlines that have been really emerging because remember, markets have been hitting all-time highs in the United States, at least in July. Bonds are screaming recession, stocks are screaming recovery. Central banks have turned economics into a farce, which is a great way to put it. Here, the green line here, Max, is the S&P 500, all-time highs, record highs, going up. That's the 10-year Treasury bond yield declining. You see, before 2008, they used to move together. Yields would rise when the economy was booming, things were going, the markets were going up, and yields would decline when the economy was bad. So, is the economy bad? Are we in recession, or are they boom times? What's the answer?
Well, that chart is the famous alligator jaw of death, which precedes generally some event which brings back a reversion to the mean. Look, markets are, for the most part, not efficient. The efficient market hypothesis has been proven to be farcical. And what we're seeing here is a classic case of markets that are trading at levels that are extended and beyond the norm. I mean, this happens, and you have an event usually that comes along to restore some order. Now, we live in an era where every single problem is met with more money printing, and to the extent that I think has really captured the imagination. That there seems to be no problem on earth that can't be solved by money printing. There's no corporate failure, no earnings failure, no wage failure, no inflation failure, no shrinkflation failure, no foreign policy failure, no election fraud failure that can't be cured with money printing. It's the elixir of life. It's the snake oil that keeps giving. It'll never stop. So the thought process goes in the minds of these central bankers who equate themselves with godlike figures who float through the universe, giving away the ambrosia of unlimited central bank policy money printing. And like the famous mythical flight to the sun, when those wax wings of monetary policy melt, you have a reversion to the mean. The kid drops down onto the earth and cracks a skull. This is Janet Yellen's fate. She could be the setup gal. She could be the one to inherit the big reversion to the mean in a big bloody mess on the carpet of capitalism. What happened here? That's Janet Yellen being reverted to the mean. Somebody call security. Somebody call housekeeping. This is an ungodly mess. And it could happen at any moment. Even
the likes of Microsoft are trading at all-time highs, and they're on a price-earnings ratio of 50, over 50 now. So things have gone bonkers once again, and thanks to the central banks. Now here's a tweet from MarketWatch. Investors are buying bonds for capital appreciation and stocks for income. The world has turned upside down. So we've gone from farce to the world turned upside down. So there's a theme here that of this farcical nature of the intervention has created markets that mean nothing, prices that mean nothing, economic data that means nothing.
Well, there's an architecture to markets that is being violated here. The fact that bonds are being bought for capital appreciation and stocks are being bought for income shows that the basic architecture of how these markets are constructed going back 100 years, 150 years is completely turned upside down, as you point out. So the ability, therefore, to create businesses in this environment is quite difficult because the only game in town is to front run what the central banks are doing. And that is to say, you're going to borrow money at 0%. You can hope that they're going to continue to ease money. They're going to continue to buy bonds in the open market. And then you're going to get your greater fool theory kicking in. And you're going to be capitalizing on that. But this is, again, it's a completely unsustainable tulip bulb mentality. I mean, you go back in history and you find manias, and you find things like the tulip bulb mania in the Netherlands going back a few hundred years, where people are buying a single tulip bulb for the value of the entire,
year's income.
Year's income and what have you. But this is the manic phase that, like night follows day, and ends tragically.
And here's another headline. Remember, the Treasury yields are showing recession. And ordinarily, you would go into defensive plays if you're believing that we're in recession and heading to bad times. But everything's soaring. All the S&P 500, tech stocks, everything. Like there's animal spirits there. Another one of the safe sectors, of course, is utilities. A big sector that Warren Buffett is always invested in. Wall Street's safest bets are now in bubble territory. Utilities, a sector traditionally viewed as a safety play in times of market turmoil, have risen 21.2% in the first half of 2016, the sector's best first half performance in over 25 years. And now this means that the most commonly cited valuation metric, the 12-month forward price to earnings ratio of the S&P 500 utility sector, is currently at 19, above its 10-year average of 14 and well above the PE of the broader index. So they're actually trading, many utilities are now trading at a higher price earnings multiple than tech stocks.
Seeds and stems. Are you familiar with that phrase?
No, what's it mean?
Well, now that America has gone very pro-marijuana, there might be an understanding of this phrase out there in Colorado. In other words, when you've smoked all the marijuana in the bag, you start smoking the seeds and the stems is what's left. And this is what we're seeing in the utility sector. They're pumping up a group of stocks that has no reason to be pumped up, but because they pay a dividend higher than a negative interest rate that you're getting on a 10-year Treasury bond, people are bidding up the prices. But they're not, that high that they're getting in these stocks is a fictitious high. It's a momentum high. It's not really a good, sustainable high. And I don't think if High Times Magazine were going to rate this utility play, they'd give it a very good rating.
Totally, dude. We've gone very far with that. So let's go back to this before we move on to the next headline I have here. But even as utility stock prices have risen over 20%, expected earnings growth for the sector in 2016 is only 4.4%. But when investors rush in and earnings don't grow, valuations get dangerously frothy, analysts said. The trailing 12-month PE ratio for utilities, currently at 19.85, is higher than that of the typically more volatile tech sector at 19.16. Remarkable that investors have lost their mind. As we said at the top of the show, everything is farcical and upside down. Everything's turned upside down. And I want to also turn to another headline and another chart to show you how central banks have created not just farce, but tragedy. U.S. money velocity worse than during Great Depression. Here's the chart, Max. This is during the Great Depression, money velocity dropping. Here's the boom times of American industrial, sort of post-World War II, the time that many Trump voters want to get back to, when Make America Great Again, when they had incomes rising and real wealth being created. And by the way, we were on a gold standard then. And one of the things that many people who are against the gold standard and against gold say that you have no money velocity. Well, there's the opposite of it. And now we have just complete collapse. It pertains to some of the stuff we talked about in the last episode. There's no new creation of industry, no new businesses being created or formed. Part of that is because of this, that the banks are taking the cash and they're not circulating it. They're not lending it out, other than to property speculation, which is a guaranteed risk-free sort of investment. Yeah,
I mean, you mentioned Microsoft there as the stock going up. I mean, they're very famously gaming the options market by buying in the puts on their own company and then buying back stock in their own company. It's technically illegal, but they do it anyway, as are most of the corporate cash desks activities at these S&P 500 companies, what they do on a daily basis, having serviced that industry myself, is technically illegal, but it generates a lot of profits and revenues. Nevertheless, it's not based on an underlying business case or that they're providing a service that anyone really wants to pay money for. They're just manipulating the markets, gaming the system, extracting wealth with the free money they're getting from the banks, paying no interest on that money, and then they pat themselves on the back and say, we're, masters of the universe. At the same time, the world that we live in, of ecological holocaust and massive terror, is a world designed by bankers, for the benefit of bankers, and we should keep that in mind.
Farce, upside down world, collapse in liquidity, and also money velocity. Now we have collateral damage in this final headline here. Collateral damage, the impact of Russia sanctions on sanctioning countries' exports. Now, just like the central banks intervene and try to think that there's only winners that they create, no losers, well, here we have the collateral damage. This is a study by 2 French economists. It's published on CEPR website, the Center for Economic Policy and Research. Economic sanctions serve as a foreign policy tool, but they can also hurt domestic firms doing businesses in the target country. This column looks at the effects of sanctions imposed by 37 countries on Russia over the conflict in Ukraine. The estimated loss of exports to Russia totaled $3.2 billion per month between December 2013 and June 2015. This loss was mostly incurred by European economies and in products not targeted by retaliations. French firm Level Data points to a deterioration of trade finance services as the dominant mechanism. So 37 countries representing 55% of the global GDP had these sanctions, and the media, as the article points out, actually hasn't reported on it, but they've actually suffered, and mostly EU member states bore 76.7% of the lost exports. And a lot of it is because of knock-on effect of finance. So banks won't lend to these companies to send the goods there, and therefore there's been a huge contraction, especially in Germany. It's almost entirely from the non-sanctioned products that it has collapsed.
And French companies are now opening vineyards in Crimea.
Well, let's go get some.
Well, fantastic. Don't go away. Much more coming your way after the break. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to the one, the only, Gerald Celente. Gerald, welcome back. Oh, wee, woo, oh.
Hey, thank you. Thank you.
All right, Gerald Celente. As a trend and analyst, you look at different, you look at markets for price signals to give. I mean, I was working on Wall Street. There was always this notion that, well, the price of cotton is telling us that the global market is going to do X, Y, and Z, because traders tended to discount the future more rapidly than the news or events themselves. There's an old adage, price precedes news on Wall Street. And yet we live in an era now where the price discovery mechanism, where price is being completely obliterated by all kinds of factors. We live in an age where people are buying bonds for capital appreciation. They're buying stocks for income. This is a complete repudiation of every economics textbook that's ever been written since the beginning of economics. You, as a trends forecaster, how does this affect your ability to pick out trends? How do you deal with that?
It's very difficult. You can't you can't forecast trends like you used to because there is no true price discovery, just like you were saying. So when you look at the stock market, for example, why does it keep going up? It's very simple. The market goes up when there's good news that there may be more helicopter dough falling down, more stimulus, and even lower interest rates. And nobody's ever heard of negative interest rates. I like you, Max Keiser. You and Stacey Herbert are 2 of my favorite people on the air. I got a deal for you. I got this 20-year bond I want you to buy from me. And when you cash it in, I'm going to give you less than you paid for it in 20 years because you're such nice people. Why would anybody buy these things? Nobody's ever heard of this in history. Nobody's ever heard of negative yields. And by the way, to turn it on the other side, that's why when people ask me, because they know that I'm bullish on gold, and I say to them, do you think buying gold now will be worth more in 20 years than that negative yield that you have on the bond that you bought? And isn't that a nice word, negative yield, to really cover up the stupidity of it all? And again, when you look at it, what are we talking about now as we're on the air with the Keiser report? $13 trillion worth of negative yield bonds. And all this is doing, and you know the numbers, I mean, you are a Wall Street guy. You're seeing all the stock buybacks. What, in the first 3 months in the United States? About $150 billion worth of stock buybacks? Look at the merger and acquisition activity. You're borrowing the money for nothing. Buy back the stocks. Drive up your equity prices. Oh, even though they just came out with the earnings report, yeah, and the averages are lower than they normally are, and they've had negative earning reports for what? The last 2 quarters? And then you look at what's going on with the exports going out of China. Well, they're way down. How about the imports? Well, they're down too. How about in Japan? Not so happy over there, is it? Negative imports, negative exports. Look around the world. Look at the turmoil. How about going down to Venezuela? It's wonderful. You only have over 1,000% inflation. How about Brazil? They're only in their worst recession now in about 100 years. So going back to the markets, going back to bond yields, going back to the Brexit, what's the pound down now to? 30-year low, 31-year low it hit?
Let's talk about Brexit for a second, because here's an instance of the population basically trying to stop globalization and accelerate deglobalization, accelerate de-dollarization, because the winners and the losers in the globalization offering are not being spread out in any meaningful way. It's all going to a very small percentage. So those who have been left out. So this trickle-down economics that was introduced under Reagan and Thatcher, after 25, 30 years, people are beginning to realize that nothing trickled down to them. And so this proposition of neoliberalism, of globalization, was a false promise. And so they're figuring out ways to jam it up, because they want it to stop. Stop the world. They want to get off. They want to get off this nightmare. So they're voting for Brexit. They are engaging in, I would posit that a lot of the violence we see around the world today is the result of people trying to put the brakes on this thing called globalization, because it's not working. It's a false bill of goods. So is that trend going to accelerate? And what does it mean? I think up here in Kingston, where we are this week, we're seeing a return to localism, local commerce, local businesses, and that seems actually to be working. Is that a fair statement?
It is. And let's look at the facts. What was it, a McKinsey report that came out a couple of weeks ago that showed that between 65 to 70% of the people in the richest countries in the world over the last several years, their wages have either declined or stagnated? I mean, those are facts. In the United States, what do you have, 400 people that have more, I think it's about $2.5 trillion? So yes, the Brexit is real. Going back to local, here's the trend. It's called self-sustainability. Take a country like England, 65 million people. Could they make their own clothes? Could they make their own shirts and shoes and computers? Can they grow enough of their food? They have enough natural resources? The globalization is only helping the multinationals.
Well, they could do that, but the GDP goes from roughly 2.2 trillion pounds to less than 1 trillion pounds.
Yes, but where's the money going?
Okay.
The money's staying at home.
That's right.
And
but
that's
that means
the big difference.
Property market crashes, stock market crashes, and you have an Iceland-like situation in England. But our people in England and the UK, do they realize that's the bargain they're making with Brexit? That they're willing to accept their GDP getting cut in half, that they're now going to be actually sustenance farming. They're going to be farming for food, to eat, to stay alive. And I mean, that's what Brexit means. Do they understand that? Because I think if you talk to people in Britain, they think that, or Boris Johnson, the new foreign minister, that we're just going to cut all these deals on the side anyway. Brexit is meaningless. We'll still get all the benefits of doing world trade, but we won't have to pay for it. Typical kind of British penny pinching attitude. But I don't think that's really going to happen. They're going to revert back to a much smaller economy, a subsistence level of economic activity. And I don't think people are going to like that, having to grow their own food to eat. I don't think that's going to go over well.
Well, what I'm saying is to be a self-sustaining economy is different, because when you're talking about half the GDP, where does a lot of the GDP come from in the UK? It's just gambling. You know, it's the City of London. It's not like they're producing anything. So that money that the multinationals are making, it's not going to go overseas. So whatever country it is, here in the United States, what, 320 million people? If we were doing business, it's beyond going local. It's like, how about made in America? You want to be an entrepreneur in the UK? Start stamping out those products made in UK, made in the United Kingdom with pride. So the money, yes, the GDP is big, but it's an inflated GDP by the equity markets. And by the way, that's the important element. The equity markets are hiding the real decline of the true economy. It's not until the equity markets fail that the people will realize how bad it is. So this is a false front. Yes, the GDP may go down, but if the farms in the UK started selling things to the people, if the people said the City of London shirts or Manchester shoe factory, people will have a pride about that.
Oh, yeah, well, okay. Well, the dream, the British dream, is different than the American dream. The British dream is to have a lot of buy-to-rent properties, live like a rentier, monarch, or aristocrat, don't work for a living. That's the British dream. If you take that away from them and say, now you've got to go stamp out pottery and shirts and wedgeware and Chippendale furniture for a living, they're not going to like that. They've been fat on rentier nonsense for 30 years. They don't know what the word work means anymore. Unless you're a spiv in the City of London and you're cranking out trillions of dollars worth of worthless paper, you're out there watching the Queen on TV saying, that's going to be me someday. I'm going to be the Queen. Pass me another chips and a bottle of booze. I mean, there's no work ethic that's going to replace the destruction of the economy through Brexit. That's, as an observer, that's what I'm saying. In the U.S., I think you do have entrepreneurialism. I think you will see a rebirth of the American dream because you've got a history of it. You know, you just don't have it in these European countries. They're socialists.
Well, again, some countries will make it, some countries won't. And you were talking in the earlier segment, we were talking about the Black Plague.
A cheerful topic.
Right? So what? 60% of Europe was from the nobility down to the peasants. And what followed it? A renaissance.
A renaissance.
So yeah, for 30 years they've been doing nothing, and maybe they'll go through some tough times, but maybe there'll be a renaissance because you're either going to survive or you'll go away. So who knows?
Now, we saw a remarkable phoenix-like rise from the ashes in Iceland. They took their hits, and they're now self-sustaining, and they're a model economy. Like a lot of us, like you said, I said, that take your hits and start from scratch, and you can, but keep your integrity. That's what they were able to maintain, their integrity. Whereas in the Britain, they've traded their integrity for a quick Brexit nonsense. And in the U.S., it seems like they're willing to also trade their integrity for hope that that they can somehow sail through a depression by just printing money. Printing money is a disease, like cancer. Would you agree with that?
Oh, absolutely. It has never been done before. Like, it's not capitalism. You know that. In capitalism, you rise and fall on your own merits. You don't have the banksters rigging the deal. You know, nothing's really changed since the days of Jesus Christ chasing out the money changes. Only the names have changed. It's the same group, just doing different deals at a different time. But I want to really emphasize the entrepreneur opportunities for maybe those people in the UK that have a spirit of entrepreneurism to start making products and to start setting the stage and putting the stamp on it. Because a lot of that emotion was, we want our country back. Oh, you want your country back? Then make your country something. And don't depend on the government to do it.
Well, let's do this event in England next year. In Manchester, in Sheffield, in London. Gerald Celente storms the UK. Good idea? Well, we've got to wrap it up. It's been fantastic to be up here, and there's so much happening in the Hudson Valley here, and Kingston is a remarkable town. You know, we were in Philadelphia recently and saw a lot of Americana, the architecture of the era and the history, but so much of that is right here in Kingston. It's amazing.
Max, we're sitting on, right now, the most historic corner in the United States. It's the only place on each corner where there's a pre-Revolutionary War stone building. Right now, we're in the famous Academy. People, Van der Linde, the great painter, one after another, with students right here in the 1774 Academy. Again, the seeds of democracy, many of them, were sown right here. We have, right in this courthouse, the Kingston Courthouse, judges such as John Jay were over here. And the Constitution that was written for New York State, this was the first capital. Much of America's Constitution was taken from the Constitution that was written here.
Fantastic. We got to cut it up there. Gerald Celente, thanks so much for being on the Keiser Report.
Thank you for having me.
That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Gerald Celente. You can follow us on Twitter at Keiser Report. Until next time, bye, y'all.